You should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And
Euphemism for.
So 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine. And you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. One of the things I find a couple of rules I want to throw out that I find useful, excuse me, is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down?
Let's take a look at the life and investment philosophy of legendary investor Peter Lynch. 1. Life and career. Early life. In Newton, Massachusetts, USA in 1944. He lost his father to cancer when he was 10 years old and became interested in the stock market while working as a golf caddy. His rise to fame at Fidelity. He began his career as an intern at Fidelity Investments in 1966. In 1977, at the age of 33, he became manager of the Magellan Fund. Over the 13 years from 1977 to 1990, he achieved an average annual return of 29.2%, significantly higher than the S&P 500's 12%. He grew assets under management from $20 million to $14 billion, recording the best performance in history. He was also characterized by high volatility, such as 94% in 1980 and minus 9.6% in 1987 Black Monday. Early retirement. He retired in 1990 at the age of 46. He explained that he did so to prioritize time with his family. 2. Core investment philosophy. Buy what you know. He focuses on companies that offer advantages in everyday life, such as Taco Bell and Dunkin' Donuts. Popularization of the PEG ratio. He evaluates the undervaluation of growth stocks by dividing earnings growth rate EPS growth by price earnings ratio PE. Although he was not the inventor, he used it in practice and made it well known the importance of a long-term perspective. He emphasized that 10-baggers can be found in familiar places. He thoroughly investigated financial analysis and the quality of management. 3. Results and paradoxical lessons. Examples of failures of individual investors. According to a Fidelity survey, about 1/3 of Magellan Fund investors concentrated their investments during periods when the fund was falling and were unable to achieve their average return. Lynch warns, instead of trying to time the market, hold quality companies for the long term.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept onto it, and it went to 1. And it was the largest position in Magellan in 1978. When it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up.
Come out of left field.
So volatility will occur, and markets will continue to have these ups and downs.
These ups and downs.
I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out what mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. because profits will go up 8% a year and stocks will fall. That's all there is to it. October has always been a special month. I remember in 1987, I was very convinced the market was not in trouble, and I didn't worry about things. And Carol and I had planned this great golf vacation to Ireland, and we were going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland and play golf. And we left on a Thursday night, and the market went down 55 points that day, which was not too good. And the next day we got to Ireland, because of the time difference, we'd completed our day, and I got back to the hotel and I called in. The market had gone down 112 on Friday.
Time difference.
I said to Carolyn, I think if the market goes down on Monday, we're going to have to go back, and so we stayed there for the weekend, and on Monday the market went down 508 points, and my fund went from I think 12 billion to 8 billion, and that gets your attention, in two working days. I said at the end of this week I'd be have no fun. Now there wasn't a lot I could do. I mean, here I was on Monday, because the market didn't open. By 12 o'clock it was in Ireland. It was still 7 o'clock in New York. So we did spend that day, and we played a round of golf in the morning, and then we went somewhere and sort of watched the market deteriorate. And I did come back. There wasn't nothing I could do. I mean, just nothing I could do about it. But I think my shareholders, they called up and they said, "Well, what's Lynch doing?" They said, "Well, he's on the 6th hole, and he's he's even par up to now, but he's in a trap. This could be, this could be a triple bogey here. This could be a big inning." And I don't think that's exactly what they want to hear. So I could do something about this damn thing. So I came back home and suffered with everybody else.
Suffered with everybody else.
And fortunately, I was very consistent. The market went down. When I ran Magellan on 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9, and because it's very important. It's another one of these numbers you got to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times. And but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. As long as the times you're right, the company's doing well, they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just wrote those out, and I will now flip a coin to tell you where the market will go to 4,000 this year or next. Heads means it goes up. It's a 2-headed coin. The market will go up in the next year. That's all I ever know about the stock market. You'll be very pleased in 10, 20, 30 years. Stocks will beat the hell out of money markets. They can beat the hell out of bonds. This is important whether you're investing for a 4-year-old, a 14-year-old, or a 74-year-old. You have to say, what am I going to do when the market goes down? Because I've had audiences like this, larger audiences, and I'll say, how many people in the room are short-term investors? I've never had anybody ever raise their hand. I mean, everybody in the world is a long-term investor until the market goes down.
Let's take a look at what Peter Lynch did after retirement. 4. Activities after retirement. Involved in mentoring the next generation as a senior advisor at Fidelity. Founded the Lynch Foundation and focused on education and medical support. His book, How to Win on Wall Street 1989, became a standard Bible for individual investors. 5. Influence on future generations. Presented the fusion of growth investing and value investing, influencing modern fund managers. Asserted that ordinary consumers can make better investment decisions than experts.